Hi, everyone. It's Jonathan Weaver. I'm the housing counselor with the Mon Valley Initiative, and it is Thursday, April the 27th. And this is our second home buyer club of the year. We plan on doing four in this year. And the idea behind the Home Buyers Club was to initially meet with people who are interested in home ownership, kind of guide them or share with them maybe some areas to focus on. And then to add these periodic homebuyer clubs to kind of get people together and pepper in maybe some new knowledge or more information as you're working on different things that you might be working on. So for everyone that's ready, then the idea would be to maybe introduce you to some people that might offer programming or assistance as you're learning to work towards home ownership. I've always felt that it's almost unfair that everyone knows more than the home buyer. The seller knows more, the agents know more, everyone knows more than our home buyers. And we're just trying to maybe level that out again a little bit more. So this evening, we have David Reed with Citizens Bank. Now, Citizens Bank has been a longtime supporter of MVI. We actually have a loan, I believe, with Citizens Bank that we originated there in Homestead on our office building. So, we and Citizens has believed in the work that we do for many, many years, and we appreciate that. So, David is probably our third year, David, that you've been willing and generous enough to
Yes.
present your time.
Yes.
And David's a CRA mortgage person. He works with people targeting low, moderate income, and that doesn't mean you have to be low income. I know David will work with everybody, which I think helps broaden his base of knowledge for anyone thinking about getting a home loan. So, David, we can't thank you enough for sharing with us tonight some ideas and concepts, and hopefully there's something out there for anyone that watches, because this becomes part of our library. We keep it on Instagram and maybe in Facebook. I think videos, it's searchable, so it becomes part of that library of information that people can search into the future. So thank you so much, David, for being kind enough to share your time with us this evening. So
Absolutely. Well, thank you, Jonathan. And what I'm going to do here is I have a little presentation. It's going to go over and essentially do some broad strokes over the home buying process. We're going to kind of review things, but also this seminar is for you. So if you do have questions specific to your situation, that's why I'm here to help answer those questions and help create solutions for you. So we're going to start here with the home buying. Let's see if I can share this. There we go. All right, here. So let's do this. All right. Can everyone see this?
Yep.
Okay, great. So first, we're just going to start off and talk a little bit about who Citizens is. We're actually one of the largest and oldest financial institutions in the country. We were established as Citizens Savings Bank in 1871. Currently, our headquarters, our corporate office is in Providence, Rhode Island. This is a little dated. We currently have over 1,200 branches in 13 different states. Recently, essentially going all up and down the East Coast, from Florida all the way to Maine. And in addition to that, it says we're recognized as a top 25 mortgage lender. We're actually, last year, we were recognized as a top 20 mortgage lender. So we're moving up a little bit, but we are a regional bank. We're not a super large bank like some that you may have heard of, like Chase or Bank of America, things like that. And there's obviously benefits to large banks, just as there are benefits to regional banks. But one of the things that we do at Citizens is our commitment to our community. It's one of the reasons why we contribute and do these types of seminars with the Mon Valley Initiative, as well as other nonprofits all through Western Pennsylvania. Okay. So some of our goals that we want to go over and talk about today as far as home buying is that, what are some of the advantages of owning your own home? What are some disadvantages of owning your own home, and what are those? How do we determine, okay, are you ready to buy a home? Or if you're not ready, what are the steps that you need to take in order to get ready? Some of the costs of home ownership, a lot of, things become very redundant when we rent, or, even the job we work, different things. So what are some of these outside things that we may not have thought of that go into the cost of buying or owning your own home? What is the process to go through to buy your own home? How do you get from here to turning your key and actually walking in your front door? Why it's important to get pre-qualified for a loan before you actually shop for a home. All right, we're going to talk about why that's important, and then just discuss, the actual mortgage qualification piece to that purchasing process. And then obviously all the steps we need in between, from you finding your house to you walking in your house. So the first one we're going to talk obviously about is the advantages and disadvantages of owning your home. So one of the advantages is that when you own your home, your property value more often than not will increase over time. This is almost like a little piggy bank just for you. There's some potential tax benefits that are available. These are things like having to pay your real estate taxes on your property. These are potential write-offs for your taxes. This one I always find amusing. No restrictions over your living space or decor, right? When you rent, there's obviously some landlords that don't want you to paint, don't want you to hang pictures, there's certain restrictions that you have, right? But in your house, if you want to put, a toilet in the living room, you're absolutely allowed to. So in addition to that, when you own your home, you feel like you're more a part of your community, more part of that environment, and it creates a sense of security and stability. And then to a certain extent, you have a certain degree of control over certain housing costs, whereas with rent, you may had a fixed payment for certain things. Okay. Now, what are some of the disadvantages of owning a home? And we're going to go through these in detail. Like, the initial investment for a home can be somewhat overbearing. It is, in some cases, can be a larger financial investment. Do you have to sell a home, or do you have to get moving, a mover to help you move? These are obviously additional expenses and things you have to, think of. Also, when you own your own home and something breaks, it's your responsibility to fix it. It's not as simple as, calling the landlord to say, whatever happened, they need to come fix it. Property taxes, one thing I mentioned as far as the tax advantage, but that's also the responsibility of the homeowner, that you are responsible for paying your taxes, your property taxes. And we'll talk a little bit about that, because actually federal tax and property taxes are the only things that can be superseded as far as a lien on your property in front of your mortgage. All right. So these things are important. Right. And the last one says value of your home may remain flat or go down. We have to put that there. It's not to say that homes traditionally go down or remain flat, especially here in Western PA. We tend to step outside the larger city dynamics of New York or Miami or Chicago, and how they fluctuate. We tend to rise slow and steady in Western PA. We don't make huge jumps up or huge jumps down. Okay. So are you ready? Let's ask ourselves some questions. What are your personal reasons for owning a home? Has it always been your goal to own your own home, right? Why are you going to live in this home forever? Is it your starter home, right? How much money do you currently have, or how much money are you going to need to be able to put down on a house to pay for closing costs? And this is probably the most important one, the questions that you ask. Can you pay your mortgage payment and still make all your other debt payments? Okay. The last thing any of us want to do in any situation is put someone in a position to where they feel house poor, right? And those are things that we want to be able to answer those questions, so you can feel confident that your next step is pre-qualifying and getting pre-approved for the purchase of your home. So let's talk a little bit about the upfront expenses of home ownership, right? You have your down payment and closing costs. What if you have any major purchases? You may be buying a house that doesn't have a refrigerator in it. You may need to purchase those appliances, right? Do you have any moving expenses, or is family bringing all their trucks over to help move you, right? And did you buy a house where you got a discounted price because there was something that needed repair? Was it a window? Is it a furnace or a roof, or things that may need repaired immediately so it can be livable for you? Okay. And then you have your ongoing monthly expenses for your house, which is obviously your mortgage payment, which will include your principal and your interest, as well as your escrow account. Now, your escrow account is what is entailed in that is your real estate taxes or your property taxes and your homeowner's insurance premiums. And your homeowner's insurance is essentially fire protection, right? If anything's damaged, things like that. Also, are you purchasing a home in a condominiumplex or a homeowners association? These are where there are certain dues that may be due on a monthly basis to live in that housing plan or that condoplex. All right. Now, maintenance and home improvements. These are ongoing things as a homeowner, right? What works today may not work in 5 years, right? So these are things as a homeowner, these are little things that you do a little bit all the time, right? But also you have your monthly utilities, right? We have water, we have gas and electric, right? Cable in some cases. So all these things are essentially monthly debt that is going to be going towards your housing expense. Now let's talk a little bit about saving for your down payment. Okay, now it states here that the minimum down payment requirement for a single family home is between 3 and 5%. That is a general rule. However, there are programs, as you see underneath that, for example, a VA loan, which requires no down payment whatsoever and does 100% financing. For the most part, most of all programs are going to have that 3 to 5% down. Now, FHA, which is a government loan, just like a VA loan, requires a minimum of 3.5% down as far as a down payment. Now, everyone looks at the following bullet point and questions it. This closing costs can range from anywhere from 2 to 6%. Well, that's a pretty big range. So when you start to look at things, but one thing you have to identify is that these percentages for amount down have also a lot to do with the area in which you're buying. And the reason why is because when you purchase a property in Pennsylvania, there is what is called a transfer tax, which is essentially the state's way of charging sales tax on real estate. Now, depending on where you buy, that can be as low as 1% to the buyer and 1% to the seller, or as high as 2.25% to the buyer and 2.25% to the seller. In addition to that change, real estate taxes are also significantly different based on the township and the school district that they're in. So you can have an identical house in one school district and 5 miles away have the exact same house in a different school district. And literally those taxes could be $1,000 a year difference for the same exact house. Okay. So that's why we give a range. Now, when we look at the actual home buying process, all right, we want to kind of go through this in steps so you understand how we go through. The first thing that we want you to do is get pre-qualified for your home. We want you to understand that this much loan equals this much payment. Because like I said before, we don't want you to feel house poor. And one thing that I do as a loan officer is I ask you that question of, what are you comfortable paying? A majority of the time, it's going to be relatively similar to the rent you're paying currently. That's not always the case, obviously, because in some cases, the way rents have gone up over the past couple of years, we're like, hey, can I buy for less than what I'm paying in rent? However, we want to identify your comfort level, because at that point I can reverse engineer that. So, hey, at this payment level, this is how much money you can borrow to fit you within that payment window. So you can see, hey, this is how much I can get for this amount of money, right? So once we get you pre-approved, you have your pre-approval, you're out shopping for your home, right? You may see 2 houses, you may see 20 houses, right? But once you find that house that you like enough that you want to put an offer in on, what they do is they generate a real estate contract that you put your offer on and sign it and submit that to the sellers. The sellers will then either agree or counter offer or deny. So let's say they agree. If they agree, they're going to sign that offer that you submitted to them. Once they sign that, you now have an executed purchase agreement for that house. You have a signed contract saying you're willing to pay this amount of money for this house, and the seller is willing to sell you that house for that amount of money. At that point is when we physically apply for your mortgage. Now, you may ask the question, well, why am I waiting that long to apply for my mortgage? Because you can physically not apply for a mortgage until you have an address of your property. Okay. So we can pre-approve you all day long, but until we have the actual address of the home that you'd like to finance, you technically cannot apply for the loan. Now let's go through a little bit. Pre-qualifying is not a very huge intrusive step, right? We go through the process of, why are we doing it? So you can shop with confidence. You know what you're looking at. The worst thing that we could do is send you out, sure, I'll get you pre-approved, just go out and find your house. Well, let's say you you fell in love with a house that's out of your price range, and now you're disappointed. So that's why we want to get pre-approved first, pre-qualified first. So we don't have you shopping for houses that you may not qualify for, or you're not comfortable paying the mortgage on. Okay. So when you apply for your loan, and this is through the pre-qualification process as well, we look at a few different things, right? We're going to look at your ability to repay the loan. We're going to look at the market value or the appraised value of the property that you're looking to buy. And we're also going to take a look at how you've done as far as your other credit obligations. Now, when I say that, some people, everyone at some point in their life, whether you were 18 out of high school or you lost your job in your 30s, has an experience with a creditor and maybe not meeting that obligation on time, right? We look at your entire history and we give the most weight to what has happened in the last 24 months. Okay. So that's not to say that people can't make mistakes, right? Everyone makes mistakes, right? We're not going to hold something against you that's 10 years old is my point. Okay. Whoop. So 5 key considerations when we're qualifying for a loan. First one is your employment history. For W-2 employees, we want to take a look and say, hey, how long have you been on that job? Do you receive overtime? Do you receive bonuses? Are you full commission or are you hourly? Are you self-employed? All right. All these things we're going to take a look at, right? And there are some questions behind that. So anyone, and especially coming out of COVID in 2020, whenever you have a job gap, or you are unemployed for longer than 60 days, the underwriter would like an explanation. There could be all different types of reasons why. The most recent reasons, obviously, because of the pandemic, was because, well, COVID was here. They shut down my work for 9 months or wherever it was, right? Now, as we slowly start to get back out of that, that is becoming in our past, which is great. Okay. But these are things that the underwriter is not a super scary person. They are a person just like you and me. And there could be things that have happened. Hey, you know what? I lost my job because, I'm a loader and I broke my wrist and they let me go and blah, blah, blah. Like we're not looking for made up stories here. They just want to understand why the situation was longer than 60 days. We're going to look at your income and your assets. So like I said before, are you paid hourly? Are you paid on commission? Do you make overtime? Right? All these different things and forms of income are going to go towards your qualification of what we can approve you for. And then what type of assets do you have? As far as assets, this could be a retirement plan with your employer. This could be savings bonds that you've had saved, right? These are all forms of assets. And the reason why we look at assets is not always because, okay, do you have enough assets in order to close on your new home? But the underwriter also likes to see, hey, if an emergency happened, do they have additional funds that they could pay their mortgage with? They call those reserves. Okay. So if you have a 401k that has, $5,000 in it, and that you're not using that for your down payment, the underwriter wants to see that to say, hey, you know what? Their mortgage payment's $1,000 a month. So in case something happens, you have 5 months worth of reserves. We then evaluate your debt. Okay, so we want to take a look at how much are you paying on a monthly basis. This includes car loans, student loans, credit cards, installment loans. Okay, most things that are reported to your credit bureau. It's not going to include insurance, your cell phone bill, your utility bills. Okay, and then obviously your credit history, which we touched on. And then the appraised value of your property. Now, the appraised value of your property is different than getting a home inspection. An appraised value of your property is essentially done by a licensed appraiser that will go out and physically compare your home to homes in the general neighborhood that are similar to yours. If yours is a 3-bedroom brick ranch, they're going to try and compare those to other 3-bedroom brick ranches within a very close proximity. I say close proximity because depending on the area in which you buy, they may want to see comparables within a mile of that home. Or as you go farther outside, we'll say city limits, that it may be harder to find a house similar to yours within a mile. Okay, but they will generate that value based on other houses similar to yours.
David, can you go back just a half a second and let me
Yes.
interject here for anyone on that that we've talked, and if you remember that little sheet of paper that I write on, these 4 things are what we're talking about, right? We start with trying to establish what is the monthly income. We talk about the assets. We talk about roughly 10% of purchase price is what you need, and we talk about how you may not have all that 10%, but knowing where that 10% is going to come from. And the debt, we look at the line where we total up what your monthly debt is, and then the credit history. And if you remember from anyone that's talked with me, we talk about starting at 620, trying to get to 660, 680 to open up other opportunities. So, these 5 things, many of this is review for people that have had a chance to talk with me. That and just reinforces, this is why I do it, right? Because I know that citizens and David are going to touch on these as you're applying for not only pre-qualification but also loan application. So thanks, David. I'm sorry to.
You're welcome. So I talked about all these bullet points, so we're going to kind of go through these a little bit quicker. We want to know how long you've been on your job, how long you've been in your occupation. We talked about the job gaps, right? Do you have a co-borrower? Are they employed? If you're self-employed, how long have you been self-employed? That's probably the biggest thing is self-employed borrowers. And Citizens is not unique to how we calculate income for self-employed borrowers. So I'll explain how that is. So whenever you're self-employed, we need a minimum of 2 years self-employment. And when I say 2 years minimum, I mean 2 years that you have filed tax returns for your self-employed business. Okay. Now, how they calculate your income based on self-employed is they average your 2 years tax returns. So if you made 30,000 in one year and 60,000 in another year, they're going to average that for you to have $45,000 a year in income. Now, what I will tell you is that one of the benefits of being self-employed is having specific tax write-offs, so you don't have to pay as much income tax to the federal government. Banks recognize that. And there are things, for example, when you are self-employed that we get to add back into your income. For example, when you depreciate an asset or you put depreciation on your tax return, I can actually add your depreciation back in for your income. Okay. So what are your earnings? This is how we're going to look at it. We're going to qualify you based on your gross income. This is income before they take your taxes out. Okay. We're going to look at whether your salary or an hourly rate. Do you make overtime? Do you make commission? We're also going to calculate other things if you want to use that as income for qualifying purposes, whether it be investments, state assistance, alimony, or child support. These things don't have to be used for qualification, but can be used for qualification. And the last one here, part-time or seasonal work. This is very similar to your self-employment, where you have to be employed working part-time for a minimum of 2 years in order for us to be able to utilize that income. Now, that also, if you're receiving alimony or child support, we have to show, or you have to prove that you're going to be receiving that alimony or child support for a minimum of 3 more calendar years. Okay. So that obviously, if you're receiving that and your son or daughter is 16 or 17 years old, you may still receive it if they go to college. However, we need it in a court document. So this is going to talk a little bit about housing ratios. You may have heard the term debt to income ratios. This first equation is essentially coming up with what is called your housing ratio, which all it really is a percentage of your housing payment divided into your income. Okay. And that's how we get that percentage. Now, in this example, it is showing that the ideal housing expense ratio is at 28% of your gross monthly income. Okay. This is more of a rule of thumb and a guideline. It is not a hard and fast rule. The reason why we put this like this is because not only do we have your front end ratios or your housing expense, but you also have your total debt ratio, which will include all of these monthly debts as well, right? Your car, your student loans, personal loans, any credit cards, maybe you have to pay alimony or child support. These are all things that are going to go in addition to that. So when we put these together, we take a look at, okay, what is the total debt ratio, which is essentially your total debts, including the new housing expense and your monthly obligations, be your credit cards, car payment, things like that. What is that divided through your gross income? Now, it says here that our ideal total debt ratio would be at 36%. I will tell you that there are programs that will allow you to go up to 50% of your gross income. Okay, so I don't want you to feel discouraged and say, hey, what happens is that, okay, I only make $2,500 a month. I have a $300 car payment. My housing payment's $800 a month. And am I technically going to be qualified for that? Well, technically, yes, you could be. But it's going to come down to your comfort as far as what you want to be able to spend on a monthly basis. Now, when we review your credit history, we utilize all 3 credit bureaus, Equifax, TransUnion, and Experian. Okay, all three of these credit bureaus use the FICO scoring system. All three of these bureaus, more often than not, will give you all three different credit scores. So what do? We actually utilize the middle credit score from these three bureaus. So example, if your credit score for Equifax was 750, TransUnion was 725, and Experian was 700, we would qualify you based on a 725 TransUnion score. Now, this right here is talking about the appraisal, how it is the market value of your home. It is ordered by the lender during the loan process. It is conducted by a licensed third-party appraiser who is licensed by the state, and he is essentially an independent contractor. This eliminates the chance for bias. Okay. We want you to feel comfortable in the fact that if someone is stating that your home is worth this, that it's actually worth it, right? But we want also the appraised value, and I believe we have another slide for this, but I'm going to talk a little bit about it now, is that whenever we lend on a property as a bank, we go by the lower of the sales price or the appraised value. So what does that mean? So if you sign a contract saying you're willing to pay $125,000 for this house, but when we get an appraisal done on the property, the value of that property comes in at 115. We will only lend based upon that 115,000. So at that point, there are some things that can be done. Either you will be willing to pay $10,000 more for the house, pay over what it's worth, or you could go to the seller and renegotiate that sales price to the 115, or you can terminate your contract at no penalty for you. Essentially, you would be able to receive any hand money back. Okay. But what this does is it's also on the flip side. We don't go back and let the seller change something. So if you're willing to pay $125,000 for this same house and the appraiser appraises it at $130,000, we're still lending off 125. The seller can't come back and say, hey, I want more money for my house. And you have instant equity whenever you close on your loan. And this right here is important. The home appraisal is not the same as a home inspection. Okay. So where a home appraisal is going to give you an estimated value for your home, given its condition, a home inspection is actually like an insurance policy for you, the home buyer. Okay. A home inspection is essentially a licensed inspector will go to the home and inspect the major components of the home. This is electrical box, hot water tank, furnace, roof. Okay. These are large ticket items that you as a consumer will want to know they're operating and condition prior to moving in and finding out that, oh, we've been here a week and my hot water tank just blew out all over the floor, right? This is a insurance policy for you. Because at that home inspection, if it comes back and, hey, you know what, the inspector found a hole in the roof that was not disclosed, right? This is something that you can go back to the seller, and if they're willing, obviously, to correct their issues so you can purchase the house, great. But it's also, if they're not willing, well, are they willing to reduce the price because of this? You know, something to continue the sale. But what it does is it creates an opportunity that if something is wrong with this house that you were not made aware of, it gives you the ability to exit the purchase contract without a penalty to you. Okay. So that's why it's important to understand that your home inspection and your home appraisal are very different. Now, this right here is just a list, really, of all different types of mortgage programs that you could potentially qualify for. There are lots, okay, and everyone's situation is different. One thing I will tell you is that currently, through Citizens is offering a grant program for our first-time home buyers. This is for all levels of first-time home buyers, whether you have a government FHA loan, whether you have a Fannie Mae or Home Ready loan, whether you have a Citizens portfolio loan, you can qualify for up to anywhere from $3,000 to $10,000 to help put towards your down payment and your closing costs. This is significant. Whenever you're talking about buying a $150,000 house, as Jonathan said earlier, you should probably expect roughly around that $15,000 mark as total out of pocket. How we get there, if you have a grant for 10,000, well, now we need to close that gap to it's now at 5, right? Maybe the seller wants to contribute to your closing costs, which they can do from anywhere from 3 to 6%, depending on the program. Well, that's $4,500 at 3% there. Now we're at $500 for a $150,000 house. Now, I'm not saying this to make people think that everyone that wants to go out and buy a $150,000 house only needs $500, because that's not the case. Okay. But there are programs that can help bridge that gap to get our first-time home buyers into that new home. So next steps. This is just a broad overview as far as, talk about what you want as far as a mortgage payment. What are your goals? Okay. Get pre-qualified so you have a good idea when you go house hunting where that house is going to fall. And then begin assembling your financial records. This is not something that you initially need for your pre-approval. However, it's something that you will need, whether it be meeting with your loan officer to discuss your income or meeting with Jonathan on a one-on-one to kind of review where you're at. Okay. So these things are obviously good to have on hand. So what types of questions do we have over this?
David, I got a couple. So that came in through the email. So maybe everyone in attend, maybe someone else has a question, but I had one here. David said, what can I do to help myself in my own loan application? So what can people do? The way I interpreted it, what can people do in their own control to make their experience easier?
That's actually a wonderful question. Whenever you're completing your mortgage application and you're with your loan officer, okay, one thing that I will recommend is that whenever you put your loan application together, that loan application is going to go to an underwriter who their job is to verify information on that application with documentation that you provided proof for. For example, if you made $48,350 last year, do not put on your application that you made 52. Okay. And it's simple things like that. And what thing I do as a loan officer is I always err on the side of caution. Okay. One thing, if there is a very unique situation, okay, to where, you're babysitting under the table for your niece's kids or something like that, that's not something that you're going to be able to verify. So that's not something you want to put on your application, because you don't necessarily want the underwriter asking the questions about that. Okay. The other thing that I see a lot of is, and obviously not my fault, but I work for a bank, but people tend to be trusting banks a little less today than necessarily they may have, a decade ago. So people are having more cash on hand, where they have it in their safe at home. People call it mattress money or different things like that. I will let you know that in some cases, not all cases, but some cases, you're not going to be able to utilize those cash funds that you have, because technically there's no way to prove where you got that cash unless we're showing, hey, look at my 12 months bank statements. Every month I pull $400 cash out, and that's where I'm getting this $5,000, right? So cash becomes very difficult to prove. Okay. Now that that's not to say that, hey, you went out to dinner with friends and someone zelled you their portion of their dinner bill. Okay. That's not something that's going to raise a red flag. What's going to raise a red flag is that, your paycheck every 2 weeks is $1,200 and you deposited $2,000 in cash on this day this month, and $2,000 in cash this other month. They look for discrepancies based on income. So my suggestion with that would be to fill out it as completely and verifiably as possible.
And maybe this one goes along, and I get people, and when I ask people to send me bank statements, oftentimes, David, they'll send me screenshots of their bank statements. How does that
Yes.
work with the bank? How do you address that? Is that work?
So, and honestly, this happens quite a bit because some of the verification that we are used to today in today's digital age was not available 20 years ago, right? So whenever a bank asks for bank statements, for example, we will take screenshots. So if you take pictures with your camera on your cell phone, for example, we will utilize that. However, we need to see the entire page. I would rather see the outline of your table, right, than have a section cut off to have the underwriter question, why is this cut off? Okay. And they want to see all pages. So if you have a 2-page statement, even though the second page is blank, they want to see the second page is actually blank, right? And that runs into, sometimes people have 8 pages in their monthly bank statement. They want to see all 8 pages because depending on the program and the different things, there are certain things that they are going to check for. These are things like, have you bounced any checks? Are you negative in your account at any time? These are things that are going to raise flags for them to ask questions.
Sure. I had one come in earlier this afternoon, David. It said, the higher your credit score, the better loan you'll receive. And then there was kind of a follow-up. So it said, or the more money you make, the better loan you will get. So I think that's kind of a two-parter. So
it is a two-parter, actually. So
yeah. Does great credit equal
yes.
a
So
better loan?
there are better options.
There you go. Good.
Okay, for higher credit scores. Okay. For example, and all these programs aren't necessarily beneficial to the first-time home buyer. Okay. When we're talking about first-time home buying programs, realistically, whether you have a 640 or a 740, you're going to fall in that first-time home buyer bucket, which only allows for certain things within that program. Now, whether once you're in your house, let's say you refinance or you want to upgrade, or regardless, you have different options after you reach a 760. Okay. From 760 all the way up to 850, which is absolutely perfect credit, by the way.
Never seen it.
This never seen it either. But though from 760 up, the programs don't get any better. Okay. So there are different things, for example, borrowing power, borrowing percentages. So for example, not everyone who has a 640 credit score is going to qualify for the same down payment option as someone with a 740 credit score. Okay. So that in itself is going to change some of your buying power because of your credit score.
Okay. And there's some nuance in there too. Private mortgage insurance is less expensive for better credit. There's some pricing.
That's correct.
There's some pricing improvements that better credit people get that lower credit scores don't get. And one of the things you touched on, David, you said, first time home, you have to go in the first time home bucket. You don't have to go in the first time home bucket if you're a first time home buyer, right? You can choose to just get a regular old loan, right?
Yes, absolutely correct. And then the other part to that is that does your income play a part in your approval process? So it doesn't affect your interest rate. From what it does affect is your buying power.
That's right.
Right. So to give you a general idea, and this is a very broad stroke, right now in our situation where interest rates are, for roughly every $10,000 you borrow, it equals roughly $60 to $65 in monthly mortgage payment. So a $100,000 loan is going to cost roughly around $650 principal and interest. Now, you can move that needle all around at that point. So if you're looking at 150 or you're looking at 80, right? This may give you a general idea, but obviously the more money you make, the more money you can technically afford to purchase with.
I'm getting a couple more here, David. So someone says, does your program at Citizens for first-time home buyers have resource limits? So are there
Yes,
limits?
so I
for
understand what
people?
that means.
Okay,
That
good.
means that the requirement would be how much assets do you have after closing? Okay, so we do have a limit. However, it is a liquid asset limit, which means this is checking, savings, money market. Okay, your 401k does not count. All right, so you have $100,000 in your 401k, you have $20,000 liquid. You know, we're not going to count that as, oh, $120,000. You have too much assets, you don't qualify. Right now, our grant says after closing, you have to have less than 50,000 in liquid assets.
Pretty generous.
Yes.
Yeah, pretty generous. And then I had another one, and I love this other one because it tells me that people are topical, right? It says in the news, they mentioned people with lower credit scores getting better rates. Can you touch on
Yes.
so
I was hoping to get
that-
this question.
well, you got
Okay.
it. So I applaud whoever sent that you're in touch with the housing market, right? And that's what
Yes.
we're encouraging people to stay in touch
Yes.
with what's happening in the news.
So let me explain what they're doing. Okay, is that when we talked a little earlier, they have what's called loan level price adjustments, which means that based on your credit score and the amount that the percentage that you're borrowing, let's not say amount, let's do percentage of what you're borrowing. They have what's called loan level price adjustments. So normally the higher your credit score, the lower those loan level price adjustments are. The lower your credit score, the higher those price adjustments are. And the reason why is because people with good credit get that bonus. Now, what is going on is they are not reducing rates for those people with lower credit scores. What they are doing is they are running specials, eliminating the loan level price adjustments for those programs if you fit into certain criteria. Okay. Now, that's not saying, you know, in a way, the news portrays that as, oh, everyone with good credit now has to pay for all the people with bad credit. That's not the case. Now, when you look at it, you're like, whoa, if I have good credit, I'm still paying more than the guy that, you know, did not take care of his credit and they're waiving these fees. For me, they're charging, right? This is not going to be a long-term solution. And one of the reasons why is because of what happened in 2006, 2007 during our mortgage bubble. When you do something like they're talking about putting out in certain areas right now, you create a mortgage bubble. Why? Because you are granting credit to people who may not have qualified unless you gave them the break. That increases potential foreclosure rates. Where we were in 2006 and 2007, our foreclosure rates were roughly 1 out of 9 houses, or 9 mortgages, we'll say, went into foreclosure. You know, and that was a very tough time. That's why banks went out of business, because I was in the mortgage industry at that time. I started in 1999. And we saw, as far as what happened, is that for every one foreclosed mortgage, it took 10 good loans to make up for that cost of that foreclosure. Well, if we do the math here, you're like, Dave, well, you said 1 out of 9 mortgages foreclosed and it takes 10 mortgages to make a bad one. Yes, that's why there were banks that went under during that time, because they could not maintain that liquidity. So unfortunately, for the time being where we're at, the administration and the policymakers they've fallen back on a standpoint of they've raised rates so much over the last 14 months, right? If you just think March of last year, our rates were in the 3s, right? We're end of April and they're in the 6s. They have priced so many people out of the market because people who could afford $150,000 house at 3% interest cannot afford that $150,000 house at 6% interest. So they're trying to find a way to stimulate we'll say, when I say certain customers, the government looks at anyone that makes less than $78,000 a year as a low to moderate income worker. Well, believe it or not, that's 87% of our population of the United States. Okay, so that's a lot of people that fall into that. I'm less than, we'll just call it 80,000. All right, so they're trying to find ways to be able to stimulate that purchase market. But in reality, I think part of our problem is that we just don't have enough houses. We don't have enough inventory. We have more people that want to buy houses than we have houses actually coming on the market.
Yeah, but in some defense, I mean, when interest rates were 3%, our people couldn't buy anything because there was no seller system. It was too active, and nobody had a chance to buy homes. So they may be 6%, but at least we're seeing some homes on the market.
That's right.
Sellers that are willing to pay seller assist, help with their closing costs. So it did what it was supposed to.
And that's one of the reasons, John, that you see a lot of the real estate investors backing out of the game right now that are allowing us to go out and find these $150,000 houses, because the interest rates have gone up so much for primary residents. These people who are investing in real estate pay even a higher percentage, and it just doesn't make any sense.
Yeah. I got a couple more here, and
sure,
people have been chipping in some good ones. So do you help clients decide which program is best for their situation?
Yes, I do. Actually, that's one of my things that I take pride in, is that I explain and show you all the programs that you qualify for, explain the advantages and disadvantages of each of them. Now, I will tell you that 90% of the time, people are looking to get into the house with the least amount of money out of their pocket and their lowest monthly payment. But everyone's situation is different. And what one program may work for this person isn't going to necessarily be the same for that person. So that is something that I do definitively, because the one thing that I take pride in is not only my education, but I don't just hand you a piece of paper and say, hey, you're pre-approved, go find a house. Yay. No, well, what's the cost associated? What's the payment? What does this look like? Is this on a 30-year term? Did we even talk about a shorter term? Like, all these things are relevant to your home buying purchase.
Yeah. We've got a few more minutes here, David. So someone asked about grant programs, specifically First Front Door and PHFA. Is that something you offer?
The PHFA, currently Citizens and PHFA are working through, we'll call it their contract negotiations.
Okay, good.
So that is expected to be back on board with Citizens by the fourth quarter of this year. But right now I do not have that. I know that I had worked with the First Front Door there was a challenge because of the funds available. We were approved for that, but I believe the First Front Door has now been all reserved. And from my understanding, I didn't think there were any funds left. The same with the Fair Grant as well.
Okay.
But I may be mistaken, because that's one thing that happens, with grant funds, and Citizens is no different than PHFA or these other grant programs, is there's only a finite amount of funds. So whether it takes all year to use those funds or it takes 4 months to use those funds, once they're gone, we're kind of waiting until next year before they re-up.
And then your grant program that you mentioned,
Yes.
how does someone tap into that? Is that something that you
So
cover?
those grants are exclusive to citizens. Okay. So those grants are going to be quantified and qualified based on program. And I'll give you those examples. For example, an FHA loan, we will give up to $3,000 or 3% to put towards closing costs and down payment. For the Fannie Mae Home Ready, which is a 97%, we will give up to $5,000. In addition to that, you will get up to an additional $500 credit for taking a home buying education course. Now, that does not mean this seminar tonight, but if you met with Jonathan face to face and he went through the HUD training, which I know he knows, then we would be able to issue a certificate and that would count. If you did not want to do face to face, there's also online options. Okay. And that is for Fannie Mae. So that's up to $5,500 in grant money for Fannie Mae. And then Citizens has what's called a destination home mortgage product. And this is exclusive to Citizens. It is a portfolio product. And what that means is that loan is exclusive to Citizens. Citizens funds that loan with their own money and service that loan through its entirety. Citizens will service all loans and all products. However, any portfolio loan will never be able to be sold. Okay. So at that point, with it being our own money, we do not have mortgage insurance on that product, and it goes to 97%, as well as a $10,000 grant. Okay. Now, I will give you an example because I have a gentleman that is actually closing on his house tomorrow. And he actually does not need any money for closing on his $160,000 purchase because he got this $10,000 grant and a 3% seller assist. So literally his hand money, which was $1,500, was all he needed into the transaction. But like I said, grant, I do predict as far as Citizens grant funds will be, let's say, scaled back. They won't cut it at all together, but they will scale it back when they get to a certain number. And I see that coming probably by June.
And the last one here I have, David, that someone sent in is, what question should I ask a banker to see if they're my match to be my lender? If you were shopping for a loan, what kind of questions would you ask on the telephone as you're checking around town?
So you want to know their availability. That's probably that's the first thing that sticks out. Their availability and their communication. Okay. If there's one thing that I've known from doing this job for a couple decades now, it's we have to be available when the customer is available, right? You go to look at houses on the weekends or at night when you're done with work. It's not like you're taking days off of work in order to go look at these houses, which means, are they going to pick up the phone for you after 5 o'clock? Are they going to answer the phone on a Saturday so they can get you a pre-approval to put a bid in on a house that you like? It comes down to, are you comfortable? Do you trust that person? Okay. Because it is a big investment. All right. For most of us, our house is going to be our biggest asset that we ever have. And when it comes to interest rates and programs, a lot of us have similar programs. Not everyone's the same, but what I like to say is that when it comes to banks, we're all fishing out of the same pond. Okay. And one company may do something very well that another company doesn't, but we're all very similar. So it's going to come down to your trust level and who earns your trust, because that's one thing that you need to do as we'll call them interviewing loan officers. Which are they earning your trust? Are they trying to, get to know who you are and where you want to get to and what your goals are? that is where I am when I do my, because I'm not allowed to do my own mortgage, by the way. So, but that's something that I want to know. I don't want someone to just, hand me a piece of paper, say, yeah, go find out whatever you want. When you get a house, come back and we'll take care of stuff. No, explain to me what's going on. One thing that I tell every customer that is especially first time home buyers, but if I pre-approve you for $200,000 and you find a house for 150 that you love, you don't want to show the seller that you're approved for 200,000. That eliminates your ability to negotiate the price on that house. So I will literally change your pre-approval to whatever the asking price is on that house to not, ruin any chance of you getting a deal on a house. So, and that's another thing that I do is that for every pre-approval or every estimate you want to see based on any house, I get a cost sheet to you as well. Although, most, when we're talking price ranges, they're going to be very similar, but it's going to come down to taxes and boroughs and things like that, which could change those closing costs thousands of dollars. So that's all those things are important. So like I said, you want someone that's going to earn your trust, not someone that expects your trust.
Yeah. Okay. Good. David, it's been an hour. It always seems to fly by. You're such a
It
wealth of
does.
knowledge. For anyone out there, David's contact information has been up there on the screen. Is cell phone the best way? Email, David, what's your
Yeah, actually, that's why I only put that there as my cell phone. I do text messages. I'll take calls, like, because I obviously my cell phone is my lifeline at that point, like anytime.
Good. So, and to anyone out there, hopefully you've gained something. I think David shares a lot of key points that I think everyone can pick up maybe one or two things that will help them as they're working towards their goal of home ownership. So, David, on behalf of MVI, thank you so much for supporting us and supporting our program by sharing your time with us tonight. And to anyone out there, if you want to give me a call, let me know how you're progressing, any changes. We want to thank you for being with us tonight, and we will get the word out on the next one coming up, probably be June or July, so be on the lookout for that, and we'll have another Homebuyer Club coming up. Thanks everyone. Thanks so much.
Thank you.